Hi, so this in this session, I really want to talk about an option strategy. So in prior videos, obviously we've gone over some of the basics, and we've actually even gone over some of the pricing that can be done and how you can actually do the pricing on some of the options, the calls and the puts. And so with this strategy, which is called the diagonal option strategy, the goal is you have to kind of have uh, a direction in mind already. You've had to already have done the analysis, the research to kind of have an idea of where the price is going to move, if it's going to move up, or if it's going to move down, because that will tell you if you should position a call option or a put option. And the strategy, the good thing about the strategy is that you're not just buying a call and hoping for the best. No matter what, it's just, again, there's still a lack of certainty. But if you just buy a call option, then if the price doesn't go in the same direction that you expect, then eventually that option could expire or could lose all of its value very, very easily. And what you want to be able to do with this strategy is be able to buy a long option, but at the same time sell a shorter dated option. And that what that's going to give you is basically not only is it going to reduce the cost of buying the longer dated option, um, but it's also going to create a hedge. So, and what I mean by that is if you buy a long and sell a short, and let's go with an example here. If the strike price is at 100 and you buy a longer dated option that's 4 months out at a strike price of either 105 or 110, that price could be $10. And you sell a shorter dated option, which is 1 to 2 months out, and the strike price is going to be 10 to 20%, let's say, above the strike price of the longer dated option. And so that strike price might be 120, 125, maybe 130. And the cost of that option is, let's say, $3. And so by selling it, you're getting $3 back. And so the actual cost to you is going to be $7. And now that we've actually, let's say it's, 2 weeks has passed and the actual price of the stock actually goes down. And so obviously your longer dated option, the one that you bought, is going to decrease in value, as well as the one that you sold, this, the shorter dated option. That's also going to decrease in value. And obviously they won't decrease in value by the same amount, absolute amount. And so that let's say that the value, the difference between them is now instead of $7 is actually $6. So if you were to sell the the option or close the option position, you would have lost $1. Now, if you had just bought, let's say, the longer dated option without selling the shorter dated option, that option, the $10 option, that we have again in this example, it may have gone down, but let's say by $3. And so you would have actually lost, $3 if you wanted to close it instead of just a $1 that I've just described if by having the longer dated and the shorter dated option. That buying and selling strategy of the two dated options. And so that's the beauty of this. This is actually a way to hedge and not only reduce the cost of buying the option, but also reduce the cost of maybe if you have to close a position in the future, it won't cost you, it won't be a loss of as much as what you would have gotten if you had just gone with a straight option. So that's the beauty of it. And again, you have to know where it's going. And again, and if you're right, and again, the key to all this is always that you're always working with averages. I mean, especially you're not just working with one stock. You might be looking at 10 different stocks and maybe doing a strategy across all 10. And, based on your analysis and your research, you might be, again, 70%, 60%, maybe even higher, maybe 80% correct on your directions. And this would work out. And the ones that didn't quite work out be offset by the gains that you have gotten from the ones that actually worked out. And so that's the beauty of this. You're always working with Not you're not just doing a sequential investment on just one at a time, which you could also do. And again, you could also be right, on average, right most of the time. But if you're working with a group of investments, then on average you're going to be correct. And so on a sequential basis, looking at the different groups that you're looking at each time, you should be on the again, depending on your analysis and research, you should be on the positive side on average most of the time. And again, the beauty of this, again, it really does reduce the cost, and it also reduces the potential loss that you could have from the stock moving in the wrong direction. And if you actually look at the a couple of charts on what this looks like, so this is for a call, and as you can see, there's an underlying cost of having to buy the longer dated option and then selling the. So you actually create a corridor. Your gains are capped. Unlike if you had just bought a long option, a long call option, then there would be no cap. And so if the stock actually went up by 100%, then you would see all of that gain. With this strategy, I mean, if it does jump up by that much, you're going to be capped to a smaller gain. And the same thing holds true if you do a put strategy, where again, if it goes down, then again, you're going to gain, but you're capped on the total gain that you could actually get out of it. And but the beauty to this is that even with the caps and the call as well as the put, if the actual stock moves, a little bit more, a little faster than what you thought across the strike price of the longer dated option, you could always roll that up as well as the shorter duration option, shorter dated option. And and again, you can do that for the calls as well as the puts. If the movement is greater than what you thought and you still want to hold on to it and you see greater potential movement in the same direction going forward, then what you can do is you can actually roll not only you can actually just roll the shorter dated option, creating a wider spread. Or you could actually roll both the longer and the shorter dated option so that you continue that corridor moving forward. But each time you move it forward, you're actually accepting a small gain by selling what you had and taking essentially a newer position on hopefully what's going to be an increased or a continued motion, a continued movement in that direction that you already expected to go. And if you do that again, it's you're limiting the risk. You're actually making money. You're getting a gain out of it, but you're also limiting the risk because if it does move in the opposite direction of what you thought, your losses are going to be minimized. You can only lose the difference between the long dated option and the selling of the shorter dated option. That is the most you can lose. Unlike a stock where if it's at 100 and it goes down to 50, then you've lost 50. Well, that amount would always be a lot greater than what you would have lost on the option. And again, that's the great thing about options. But unlike stocks, you can only hold on to them for a certain amount of time, depending on the dated options that you actually get. And so there is a risk there, unlike stocks where you can hold them forever, essentially. And so if it's going to take a little longer for it to actually move in the direction that you want, you don't have to fear that that time will expire actually with a stock. But with calls and puts, then that is a risk. So obviously there is less exposure on the cost side, but there is a risk when it comes to time. And so if it doesn't quite do what you expect within the time frame that you expect, then you could actually not get anything essentially out of it. So that's the downside to the options. But again, I like them because again, they control risk. Ultimately, they do control risk. And as long as you give them enough time and based on your analysis to actually do what's expected, then you will gain and you can do quite well actually with this option strategy and other strategies that I will cover in the other videos to come after this one. All right. Thank you.